Hello everyone, welcome back. Today I'm going to be talking about the TGIF model. The TGIF stands for Thank God It's Friday. It's a model based on the idea that Monday to Thursday often deliver the weekly range or the move, which is an expansion. And by Friday, institutions began to take profits. This profit taking creates a retracement or a pullback. Traders can take advantage of this retracement for short-term profit on Friday. Now, you guys need to know that this model can only be used on a Friday. It's a model that seeks to fade a reversal of the weekly range. So if the week was bullish, you want to be selling on Friday, and the week was bearish, you want to be buying on Friday. Now, before we go further, we need to understand the weekly power of three. Here's a bullish candle. What happened here was that price opened at this point, created a low, expanded higher, retraced, and then closed here. All right. So it is an up close candle because price closed above the open price. Okay. Now here's a bearish candle. Price opened here, ran higher, created this high, expanded lower to create this low, then retraced back into the range, creating a closing price at this point. So here's a down close candle because it closed below the open price. Now, what we want to do with the TGIF model, we want to fade the retracement. So if this is a bullish week, this retracement here is all we are capitalizing on to make profits. And this is a bearish week. This retracement back into the range here is all we are capitalizing on to make some profit on a Friday. So here's a graphical representation of how the TGIF model looks like. Here are daily candles, meaning one candle represents 24 hours. That's a day. So here's Monday, Tuesday, Wednesday, Thursday, and a Friday. So these are the candles that make up a week. So here's a weekly candle. If you look, this is where price opened, created a low, ran higher to create this high before retracing, just like we see here. Okay, and usually we want to see weekly objective taking, and we expect that price, if it should retrace back into the weekly range, a 20 to 30% is visible. So here's the high, here's the low, here's 50%, and here's 30%. So we're anticipating 20 to 30% retracement back into the weekly range. So how do you identify the TGIF setup? I'll need you all to know that there are two conditions that must be met before you can use the TGIF model. The first condition is the weekly direction from Monday to Thursday must be in one direction, either bullish or bearish. When you look at the weekly range, that's from Monday to Thursday, you want to be able to pinpoint what is the obvious direction here. Is it bullish or bearish? Whenever you look at Monday through to Thursday and it's looking like it's a ranging market, or you're not sure if it's bullish or bearish, then you cannot use this model. Second condition is a higher time frame PDRA must be met. Okay, so the higher time frame include the monthly, weekly, and daily. Nothing below the daily time frame. So now, PDRAs include fair value gaps, order blocks, breaker blocks, or run on liquidity. So you're looking for these things in the higher time frame, and this time frame include monthly, weekly, and the daily time frame. Nothing below the daily time frame. So here's a point to note: high probability for reversal if Friday takes the previous daily high or low. So now if it's a bullish week, we want to see Friday take the Thursday's high, that's the previous daily high. And if it's a bearish week, we want to see Friday take what? The previous daily low, which is Thursday's low. So here's the USD yen, and this is the monthly time frame. What we do in the monthly time frame, we identify the higher time frame PDRA. So here's our daily range high, and here is also our daily range low. Why is this the daily range high? Because this is the high that has taken what? Buy side liquidity. And why is this a daily range low? Because this is the low that has taken what? Sell side liquidity. So here is a type 1 daily range. This is premium. And here is what? Discount. This is what? Equilibrium. This is the month we are studying. And you can see how price has gotten towards higher time frame PDRA, which is what? The fair value gap at a premium. At this point, the probability to anticipate a sell is high. Now we'll move to the next. Here's the weekly time frame, same pair, the USD yen, and then you can identify our daily range high here and our daily range low here. Here's equilibrium, this is premium, and you can see this week, you can see how it went into the monthly fair value gap. And not only doing that, it also took what? Buy side liquidity. Now price moves from buy side liquidity to sell side liquidity. Usually, when you see price taking buy side liquidity, you want to anticipate what? A reversal back into the range. You can either reverse completely or retrace to continue. Okay, you can see how price took out liquidity and then what? Reversed. Here again, you can see how price took liquidity and what? Reversed. You can see how price took liquidity here again and then reversed. Here again, took liquidity, reversed. So whenever price takes liquidity, there is usually a reversal back into the range. Now, not in all cases will it change direction and start running lower. It may just give a little retracement back into the range before continuing going higher. Now you can see here, let me take all this out. You can see this high was taken. As soon as price took out this high, it did what? It retraced and then rallied higher. Okay. So usually you want to expect a reversal after price has taken what? Liquidity. Now we can see that we have clear higher time frame PDRA already identified. On the monthly time frame, we have what? A monthly fair value gap. And then on the weekly time frame, we have what? A run on liquidity, which is buy side liquidity. Okay, so let's move on. Now, I stated at the beginning that you want to anticipate a retracement of 20 to 30%. Now, it can go all the way to 50, but the most probable level or a level of higher probability is 20 to 30%. I'm looking at this candle. All right, this is the candle I just brought out here. You can see it retrace down to 50%, which obviously can happen. Remember our weekly power of 3. So here's where price opened, came lower to form the low of the week, expanded higher to form the high of the week, and then retraced to close at this level, just like we see here. The same thing I explained. You can see how price retraced down to 50% after clearing the buy side liquidity and then filling this area of inefficiency in the monthly time frame. Good. So here's the daily time frame. This is Monday, forming the low of the week, Tuesday, Wednesday, Thursday, and Friday. And you can see the buy side liquidity at this point. Now, the second very most important qualification in order to use this model, Monday through Thursday should give a clear direction. Looking at this, is this bullish or bearish? It's bullish. It's clear. You can see this is Monday, Tuesday, Wednesday, and Thursday. It's all bullish. Now, it doesn't mean all the candles must be bullish, but then looking at these 4 candles, which is Monday, Tuesday, Wednesday, Thursday, it gives you a clear direction. So because we have these 2 things in check, we can proceed to apply the TGIF model. I want you to also recall that I said a higher probability is increased when Friday takes the previous daily high. So this is Friday. You can see how it retraced back into the weekly range. But before doing that, it took out Thursday's high. This increases probability in our favor. Now, it doesn't mean that whenever you want to apply this model, Thursday must always take the high for a sell and take the low for a buy. It mustn't happen. But if you see this happens, it increases the chance of this model going in your favor. Now, let's go to a lower time frame to see what happened here. Now, the next thing you want to do is to go to a lower time frame, either the 1 hour or the 15-minute time frame. What you are looking out for is a market shift. Okay, what's a market shift? This is when price takes out liquidity and then breaks structure. Okay, so you can see this high was taken, and then before taking this high, it created a low. If price comes down to break out this low, what happens? We have a market shift. Market has shifted from bullish to bearish. Same applies for a bearish market. If price is going lower and then takes out sell side liquidity before breaking this high, which was created before the low was taken, we have what? A market shift. Market has shifted from bearish to what? Bullish. I hope that's very clear. And if you don't understand, leave a comment below and I'll make a separate video explaining this. So looking at price action here, this is Wednesday, this is Thursday, and then here is what? Friday. All right, you can see how Friday took out previous daily's high, which is Thursday's high. Okay, now there was a market shift here. This run here took what? The buy side liquidity. All right, and this run started here. As soon as the low gets broken, we have what? A market shift. So this candle here confirmed what? A market shift. This candle here, because it broke below this low. So we have something like this. I hope it's clear for us to see. It's very easy, guys. So once we see this, all we are looking out for is a fair value gap. Now, this can occur either in a 1 hour time frame or in a 15-minute time frame. Most time, if it's not clear in the 1 hour time frame, you want to go down to the 15-minute time frame. But clearly, you can see in this time frame that price has shifted and it left what? A fair value gap. This is the fair value gap we'll be finding our entries. Going down to the 15-minute time frame, we can clearly see a market shift. You can see how price ran buy side liquidity. This was the low that was formed before price took out this buy side liquidity. You want to mark out that low. As soon as price breaks that low, we have what? A market shift. Once the market shift occurs, we want to look out for what? A fair value gap where we'll be finding what? Our entries. But remember, this is the USDN. The best time to trade this pair is either the Asian session or the New York session. You don't want to be trading this pair in the London. Now, price might move in the London session, but the probability is very low to get huge volatility. The best times to get volatility is either in the Asian or New York. Why? Because of the pair. The New York because of the USD, and then the Asian session because of the yen. Now, these lines you can see here represent the ICTQ zones. We have 4 ICTQ zones. We have the Asian, the London, the New York, and the London close. Why some people talk about the New York close? I only use the Asian, London, and the New York. I don't use the London close. Okay, now you can see price rated the buy side liquidity, which is the previous daily high. As soon as it rated the high, it broke lower, closing below this candle here. Let me explain better. Looking at this candle here, it formed the open at this level here. All right. Now, as soon as price closes below the open price, it confirms what our change in state of delivery. And you can see how price returned back to this open price here. This is where we're finding our entry. Also note that this occurs just as the ICT Asian Q zone kick-started. All right. So as soon as price return, you want to be entering with your stop loss above this high. So that's one method for entry in the 15-minute time frame. A more conservative method is to identify a 15-minute fair value gap at any of the relevant ICT Q zone. Now, if you look at the Asian Q zone, you would see what? A fair value gap here. You could use this for a sell, right? And if you look at the New York Q zone, you could see what? A 15-minute fair value gap. You could use this what? For a sell. This is more conservative. And more aggressive is as soon as price runs liquidity, you either want to use the change set of delivery or even go to a lower time frame to look for a market shift. And I'll explain that in the next slide. So here's the 15-minute fair value gap happening in the New York Q zone. All right. Remember I said the first way you want to tackle this is either a change in state of delivery. This is where you wait for price to close below the open price if you want to sell, or close above the open price if you want to buy. Now, not just any candle. If it is for a sell, you want price to close below the open price of an up close candle. I hope this grammar is not too much for us. Let me just go back to that. It's clearer for us to understand. So here's an up close candle. The change in state of delivery is the ICT order block. Okay, so now once price creates this up close candle, you're waiting for price to close below the open price. Once it closes below the open price, you're waiting for price to return back to that open price. Now it happened very fast here. That's why it's looking plumbed up. So let me give you another example. So here is a bearish candle, and you can see how this candle closed above the open price. Okay, as soon as price closes above the open price of this down close candle, it confirms a change in state of delivery. All you want to do is to wait for price to return back to it, as you see here, for a buy. All right, I hope that's clear. To recap, all you want to do is you want to make sure that those two conditions are met. Number one, a higher time frame PDRA must be met. It could either be a fair value gap, order block, run on liquidity, or a breaker block. And the higher time frame include the monthly down to the daily, nothing below the daily time frame. The second condition that must be met is that the weekly range must have a clear direction. It should either be bullish or bearish, not in between, not ranging, not confusing. Okay. Now, once those conditions are met, you want to go straight down to the 1 hour time frame or 15-minute time frame to look for a market shift, which I just explained. Now, once you've identified a market shift, which could either be in the 15-minute time frame or 1 hour time frame, you want to use the fair value gap at any of the relevant ICTQ zones. This is the conservative method. But for the aggressive method, when price runs the previous daily high, that is Thursday's high, or previous daily low, that's Thursday's low. Now that's if it happens. You want to use the change in state of delivery in the 15-minute time frame. And your entry must occur at any of the relevant ICT Q zones. All right. I use relevant because you don't trade all pairs on any of the ICT Q zones. Just like gold, you want to trade gold in either the Asian or the New York Q zone. You don't want to trade gold in London. Now, gold can move in London, but most times it moves either in the New York or Asian Q zones. This is USDN. You get volatile and aggressive move on either the Asian or New York Q zone. And you can see this setup happening where in Asian Q zone. So you could be entering. All right. And if you want to be more conservative, like I said, you want to use a 15-minute fair value gap that has occurred after a market shift. Now, here's our 15-minute fair value gap, and you can see how price tanked. Looking to the left, you could see that here's the 20% weekly range retracement, and then the 30% weekly range retracement, which is close to our sell side liquidity. After taking this, you want to be done for the day, or you want to take bulk of your position if price breaks this liquidity and let the rest run. So here's a 3-minute time frame. You can also use the 5-minute or 1-minute time frame. All you're looking for is a market shift or a change in state of delivery. And we can see both happening here. Let me explain. You can see how price rated the buy side liquidity here. Now, this was the leg that took what? Buy side liquidity. You want to identify that leg. As soon as price breaks through it, what we have is a market shift. Okay. Now, this market shift must show displacement evident by the creation of a fair value gap. And you can see how price created a fair value gap. It's with that fair value gap you'll be entering. Secondly, another method to use for an entry is a change in state of delivery. You can see these consecutive up close candles. You want to mark out the open price. As soon as price close below the open price, we have what? A change in state of delivery. So you draw that out and wait for price to return. You can see how price returned with this candle here. This candle here confirmed our change in state of delivery. And this candle here returned back to the open price. Let me draw it again. So here's the open price. You can see our price closed below it and then returned immediately for a sell. Another thing I want you to note is you can see how this fair value gap held price went through it. Although it wicked through it, we call this a mohawk, but then it did not close above this fair value gap. This signifies strength, telling you that this fair value gap is most likely to hold price. Okay, and if you draw the midpoint, you can see how price barely closed above the midpoint. The midpoint is called the consequent encroachment. So I don't want to bore you too many times, but these are things you look out for to assess the probability of a trade going in a particular direction. Okay, let's look at another example for those who might be lost. There's a USD card, the monthly time frame. Remember, you want to outline the higher time frame PDRA. Now, it doesn't mean you must start from the monthly, but it's actually very good to start from a very high time frame so you can do a top-down analysis and get a full picture of where price is most likely to go. All right, so here's a monthly time frame. You can see this is a monthly fair value gap. You want to also identify the daily range. So here's the daily range high. Why? Because that's taking what? Buy side liquidity. We don't see any other buy side liquidity here. That's rated all the buy side liquidity. And here's the daily range low, because that's taking what? All the buy side liquidity here. So from this low to this high, we have what? A type 1 daily range. When you draw out your fib, you have the midpoint being the equilibrium. Above equilibrium is premium. Below equilibrium is what? Discount. You want to be buying at discount, selling at premium. So we can see that price is currently at a premium. It doesn't mean that price will start falling from this point. No. What it means is that you get high probable sales at premium and high probable buys at discount. So if you want to buy, you will most likely get profitable trades if you bought at this level. Because why? You can see this month was bullish, this month was bullish, and this month was also bullish coming from a discount. All right. But if you want to sell, you'll notice that you get profitable trades if you sell at a premium. So you can see this was bearish, bearish, bearish. Okay. So bearish trades are best done at premium, and then bullish trades are best done at what? Discount. All right. So moving to the next time frame. Here's a weekly time frame, USD card. Now, on the weekly time frame, you can see how price has taken what? The buy side liquidity, which is also a higher time frame PDRA. So now we can see that the first condition has been met. A higher time frame PDRA has been met. This is the candle we're going to study, and this was happening where at a premium inside what? A monthly fair value gap. I hope I'm not too fast. All right, so here's a daily time frame. We are going to study these candles. So we can see here, this is Monday. This down candle is Monday, Tuesday, Wednesday. Wednesday formed the low of the week. This is Thursday, and here we have Friday. Now, looking at this candles from Monday to Thursday, we can see that price was what? Bullish. We're not confused. Although not all the candles were up close candles, we can see that Monday was a bearish candle, and even Wednesday kind of looked like a consolidation, even Tuesday. But Thursday was an expansion. So we can see that price expanded away from the weekly open. All right. So the weekly open is where Monday opened. This line here, you can see it correlates with this line. This candle is also a representation of what? The weekly range. You can see how the high was formed and the low was formed. Price opened, created a low, which was formed on Wednesday, expanded higher, and then retraced back to close at this point. Okay, I hope this is clear. So the two conditions are met. Number one, the higher time frame PDRA has been met, check, and price is in a clear direction, which is what? Bullish. Now, another thing that increases probability is that you can see how price Friday took out what? The previous daily high, which is Thursday's high. You want to see this, guys. Now, it mustn't happen all the time, but you just want to see this because it increases the probability. So here's the 1 hour time frame. You don't need to go down to the 4 hour time frame and all that. All you just need to do is to go down to the 1 hour or 15-minute time frame. What you are looking for is market shift if you want to go conservatively. But if you want to go aggressive, as soon as price rate what the buy side liquidity, which is the previous daily high, you want to go to the 15-minute time frame to look for a change state of delivery for a sell, or you can also go down to a 5-minute, 3-minute, or 1-minute time frame to look for what? A change state of delivery or a market shift for a sell. It's that easy, guys. Very, very easy. All that is important is that you need to understand the whole concept here. We are trading the retracement back into the range, which occurs on Friday, and two conditions must be met: a higher time frame PDRA and price must be in the clear direction. Once you get that, you can apply whatever model I'm teaching here, either the aggressive or the conservative. So let's go down to the 15-minute time frame. Going down to a 15-minute time frame, we can clearly see a market shift. So you can see how price raided what? The buy side liquidity and then fell to break what? Structure. Here we have a market shift. This is the 1 hour fair value gap. So looking at this, here's an opportunity to go down to a 5-minute, 3-minute, or 1-minute time frame for a sell, looking for a market shift or change state of delivery. And you can see it's happening in London session. Now, you don't want to trade USD card in London session, although we can see this huge move. I personally will not trade USD card in London session. I would trade USD card only in the New York session. Okay, because if you look at the pairs, it's USD, it's Canada. This is not American currency. So I would want to trade it what? New York Fusion. Okay. Now, if you look carefully, you would see that we don't have what? A 15-minute fair value gap anywhere except the 1 hour time frame. So you can see that this model is very flexible because it doesn't happen exactly the same. Sometimes you may get a 1 hour fair value gap. Sometimes you may get a 15-minute fair value gap. All I'm giving you tools that you can put together and form your strategy. All right. So it doesn't mean that you must see a 15-minute fair value gap. If you as well see a 1 hour fair value gap and the entry is occurring what? At a relevant ICTQ zone, you can take your shots. All right. So let's go down to a 3-minute time frame. So at the 3-minute time frame, you could see that this was where New York Q zone began. New York Q zone is 8 a.m. to 11 a.m. Eastern time. London Q zone is 2 a.m. to 5 a.m. Eastern time. And then Asian is 8 p.m. to 12 noon Eastern time. Eastern Standard Time. Sorry, guys. Okay, now, if you look carefully, you would see price went into the 1 hour fair value gap here and also gave us a change state of delivery. If you look carefully, you see that there's just change state of delivery here. All right, as soon as this candle closed below this candle, we have what? A change state of delivery. Although we can see how price tanked, but I wouldn't be using this. Why? It is outside the Q zone. Secondly, we can see a market shift. You can see how price ran higher, took out the buy side liquidity, and then left this low. As soon as price comes down to break this low, we have a break of structure, and it confirms what? Our market shift. And we can see a couple of fair value gaps we can use for entries, but I wouldn't use this because it's outside what? The ICTQ zone. Okay, now you can see a similar thing happening here. You can see our price run higher. Okay, took out buy side liquidity at this 1 hour fair value gap. You can see this small move here. I think I should expand. You can see this move here. All right. Price touched it a bit, hitting the low of this fair value gap, and then fell to break what? Structure. So we have a market shift here. In doing so, it left what? A fair value gap, which tells us that there's what? Displacement. Wherever you see displacement in a particular direction is a telltale sign that price is willing to move further in that direction. All right. Anywhere you see displacement, price wants to keep on going in that direction. You can see this huge move here. This is what we call displacement because we can see a fair value gap. Now, as soon as price returns back to that fair value gap, you want to be selling. The second way to do this is to use the change state of delivery. You can see how price created what two consecutively up close candle. This is the open. These are consecutive. Now, why are they consecutive? Because the next candle after this candle is also an up close candle. This candle here, 1, 2, 3, they are not consecutive because they are not the same. But starting from here, we can see that these two candles are the same, so they are consecutive candles. So you want to outline the open price and wait for price to close below it. As soon as price closes below it, it confirms what? A change in state of delivery. Now you want to outline that price level and wait for price to return to it. Now you can see that this candle here returned to it. You'll be selling here, which will stop above the high. And you can see how price tanked. All right. So here are the written down rules to use the TGIF model that you can screenshot or write down to take home to use. Remember the criteria, the weekly direction must be clear. From Monday to Tuesday, you want to determine if it's bullish or bearish. Secondly, it has to hit a higher time frame PDRA. Then for the conditions, you are waiting for a liquidity run of Thursday's high or low. This is optional, it mustn't happen. Then, if you want to go conservatively, you want to see a market shift in a 1 hour or 15-minute time frame, evident by a fair value gap. It is that fair value gap you want to be using as your point of interest. So once you identify that fair value gap, it could either be in the 1 hour or 15-minute time frame. What you do is you go down to a smaller time frame, which is a 3-minute, 5-minute, or 1-minute time frame, which is your entry time frame. You're looking for what? A market shift plus fair value gap happening at the relevant ICTQ zone. If you're trading the Euro USD, you can look for trade entries at the London or New York. You don't want to be looking for trade entries at the Asian because Euro USD has nothing to do with the Asian session. Although you can see huge moves at that session, but they are rare. Okay, so our target is 20 to 30% of the weekly range. Now, it doesn't mean that it must be 20 or 30, but then if you are holding a position, you want to make sure you've taken the bulk of the position once it gets to 20 or 30% weekly range. So I hope this was helpful. If you enjoyed this video, give it a thumbs up and do subscribe if you want to get more videos from me. See you guys next week.